Welcome to the Daily Update, where I'll go over the action in the market for Friday, April 21st, and then we'll see how things look for Monday, April 24th. You can probably tell a little difference in the sound here. I want to say hello from Germany. Had a nice day to spend in Vilnius, Lithuania, before coming down to Nuremberg, Germany. But as far as the market is concerned, we're still maintaining that positive stance. It was options expiration. We saw a lot of jockeying around. Not much was really decided on a closing basis, but we still are pointing up for the most part. We do see some pockets of weakness and some potential warning signs that we need to pay attention to, but we still are maintaining that positive stance. A couple of things to go over before I get started. Please know, yes, I am traveling now. My intentions are to do the daily videos every day, or at least every day that I'm able to do that. There won't be a weekly intermarket analysis video or a deep dive video this week. I just don't have enough time to do that. It takes a lot of time to prepare those. And by the time I'm recording this, a lot of the weekend is already gone. Some additional charts that I usually show, like IsabelNet, various blogs, I won't be covering those unless something is really obvious and in our face that we need to deal with. I do have a podcast that you're welcome to check out. In the description for both the video and the podcast is a PDF of all the slides and charts that I do use. I do have a private Facebook group that you're welcome to join. There is a new poll that I'll be posting after I finish this video, and the audio, sound, and quality may be different. I'm just using the internal microphone to record this. I'll go through and do what enhancements that I can. Of course, what's really interesting is if you tell me that it's better than it was before. So let's go back and talk about what happened. Right at the open, we had a flat open. Prices were chopping above and below the unchanged level, and the daily pivot was at 41.31. As the day went on, prices fell down to S1 at 41.13. Then they were able to climb back to the daily pivot and all the way up to the unchanged level. Prices then chopped above and below the unchanged level as well as the daily pivot. We were up 0.09%. on below average volume, which is a little surprising because it is options expiration. Our technicals are still positive overall, but we have some warning signs and some divergences that we need to keep an eye on. The markets are still fixated on inflation and interest rates, and then earnings season is pretty much in full swing now. Here's the intraday chart showing how we had pretty much of a flat open and we chopped above and below. Not anything was really decided. We went down a little bit only to come back up. We did fall down just about to S1 before coming back up to the unchanged level and the daily pivot. We tried to go positive. That wasn't happening. Came back negative, chopped around, and then ended up finishing positive on the day. Here's the large cap growth versus value, showing that value is still continuing to outperform growth. Here's a look at the end of day charts where growth was up but less than value. However, for the mid caps, growth was actually higher, and it was down less for the small caps. Here's the SPY 10-minute intraday chart. We were chopping around, going slightly down in the overnight session. Then when we got into the pre-market session, things went quite a bit more negative, only to bounce back up. We saw a little change right at the open, a very choppy session. We were up slightly on the day, and then going into the end of trading for the week, we were pretty much flat. What are some comments that we can make? Philadelphia Fed President Harker, who is a voter, came out and said that the Fed's going to need to do more to get inflation back down to the target level. Also, New York Fed President Williams, who's also a voter, did signal support for another rate hike coming up at the next FOMC meeting. The S&P may be beginning to shift more negative. We're still hanging in there for right now, but there are some warning signs that we need to keep track of. On a short-term basis, we really only have our stochastics right now. We worked off any of the other overbought conditions. The dollar declined, which gave some support to stocks, but interest rates were up and that produced some headwinds. The 30 to the 5 is still normal, where our other yield curves remain inverted. Sentiment is positive. We're at 65, where we had been at 63. Our trend is still positive, but it's coming down. The green line's on top. So that's positive, but it is showing some weakening. The ADX itself, even though it's starting to roll over a bit, is still above its moving average, but we're below 20 overall. I'm still keeping our bias and momentum at mixed for right now because not an awful lot is really being decided. The economic reports that came out, we had the IHS Market Manufacturing PMI that came out. The preliminary reading was at 50.4. Last time it was at 49.2. 50 and above means expansion in the economy. We also had the services PMI preliminary reading come out at 53.7, a little bit stronger than the 52.6 than we had last time. This is a chart that I usually show in the weekly video where it's showing that we're still positive with sentiment overall. Now they call it greed, I call it positive. Here's a historical chart showing how we came down below 25 and we've been bouncing up above that ever since then. When we get up to 75, that's when we're starting to look extreme as far as sentiment. John Murphy had one interesting chart. This is kind of a variation on some other charts that I already show you. We're seeing some negative divergence here. Down on the bottom is the S&P where it's been going up, but the percent of stocks that are above their 50-day moving average is not going up with price. And also at the very top, the percent of stocks above their 200-day moving average is also not going up. This would be a negative divergence. FactSet just came out with an update of how earnings season is going. It says the first quarter earnings for the S&P is off to a better start relative to the last two quarters. However, both the number of companies reporting positive earnings surprises and the magnitude of these earnings are below their 5-year averages. Then I highlighted another part. The index is still reporting the largest year-over-year decline in earnings going back to 2020, which is kind of an anomaly since that was the lockdowns. 18% of the companies in the S&P have now reported. 76 have reported actual earnings per share above estimates. But again, there's a little trickery going on here because the earnings estimates have been lowered. And then when a company comes out and they beat those estimates, oh, look at that, everybody's happy. It's just a sleight of hand trick that's going on. Companies overall, though, are reporting earnings that are 5.8% above those estimates. Looking at our charts, the Ulcer Index still suggests that there's not a lot of fear in the market. The VIX continues to be quite low. It ticked down a little bit on the line chart as well as the bar chart. The VIX of the VIX, which measures the volatility of the VIX, has been going up even though it ticked down a little bit in Friday's session. This is giving us a little warning sign that maybe the market's sensing something that we're not really seeing played out in the VIX itself. Here's the SKEW index where it ticked back up a little bit in Friday's session, but we're not getting an extreme reading at all. They're just predicting that these out-of-the-money options are showing some increased activity, which could suggest that there might be some kind of a big move either to the upside or to the downside. The equity put-call ratio really hasn't changed all that much. Looking at some other fear gauges, we're still dropping off with fear overall based on this chart and still chopping down as well on this other fear gauge that we use. We're still tending to favor a risk-off environment. Looking at the condition of our trend, the ADX is above the moving average but could be starting to roll over. The green line's on top and declining, but the ADX is still below 20, so we're in a trendless environment with a positive bias. The Arun, after giving us an extreme positive reading, has now been starting to come down. Looking at the daily chart, nothing was really decided. We can see on the bottom where we drop back down to below average with volume. The slope is our only oscillator that's starting to turn down more negative, and that's a little more touchy. Our other oscillators are showing a little bit of a rolling over, but they're still positive. Looking at the PPO study, we're still positive in the long and intermediate term. We're flat to slightly declining in the short term. The Stochh RSI, which had quickly gone down to being extreme negative, has now climbed back up, so it's no longer extreme. Here's the stochastic showing how we're coming down in the short term. We're also dropping in the intermediate term, but we're still extreme positive in the longer term stochastic. The force index ticked up just slightly and is above 0. That's positive. We're above all plotted moving averages. If we do start to fall, we'll be keeping an eye on the 20-period moving averages. The parabolic SAR produced another big warning sign with the dot on top. Well, we saw another dot on top after Friday. The Swindlin Trading Oscillator declined a little bit based on price and volume, and we're still playing off of this negative divergence between price and volume. The vortex is still positive, even though the green line's coming down, but the red line is starting to come up. Shaken oscillator ticked up slightly and is positive. The ratio between the S&P and utilities continued just to chop sideways, not giving any real strength. In our PMO study, we're no longer extreme with the PMOs that are rising. We're coming down now from the buy signals, and we're starting to roll over with the percent of PMOs that are above zero. We're still hanging in there okay with the BPI. Ticked down just slightly, but we're above 50. The NYSE bullish percent index also ticked down slightly, but is still above 50. Naked money flow did really spike up, so that's more positive. The balance of power is declining, but still above the dashed line. The TTM squeeze shows that we're going down now with these darker blue bars, but we're still positive. And the go, no go is now keeping it at a pale blue bar. We're still above the triple exponential moving average. That seems to be providing support and is holding so far. And then with our anchored moving average going back to the all-time high, we're still above that. And we're currently recalculated at the 4,075 level. Our short-term fib chart still shows that we're closing above this 100% retracement at 41.23. We're about 10 points above that currently. Longer term, we had upper resistance at this 50% level, and that was at the 41.56 level. And longer term, if we continue to fall, we're looking at support at the 40.20 level. If we go up, we're looking at resistance at 42.14. We're also showing major overhead resistance with our quadrant chart. We were not able to break through that. The equal weight index continues to underperform the S&P 500 index. And this is also chopping sideways more or less with our ratio. The Elder Impulse system for the S&P remains at neutral. McClellan oscillator starting to drop, but is still above zero. Then our broader range McClellan oscillator has already dropped below zero. That's more of a negative warning sign. The summation index based on price is still advancing, but we have rolled over based on volume. That is a negative divergence. The Heikin Ashi also is showing a few more black candles. The Kigi chart is still positive since it's black, but it is pointing down, so that's more of a negative bias. The new take on Dow theory, we're still above this blue line with the S&P where we broke out above this level. We were never able to break out above this level with the NASDAQ, and we're keeping an eye on that. The transports continue to underperform the Dow. New highs, new lows are going up a bit with the new highs, but we haven't rolled over yet with our 5 period. We're turning up slightly with the 10 period. The advanced decline line, still working off this longer term negative divergence between price and volume. We were pretty much flat in Friday's session, both for price and volume. The NYSE advanced decline line is still holding up overall. But longer term, with the common stock, we're seeing a negative divergence where the common stock made a higher low. The advanced decline volume for the common stock made a lower low. The advanced decline ratio, even though it's declining, it's still above zero. Accumulation distribution is still hanging in there. Volume is turning back up a little bit, mainly due to options expiration. We'll see if volume can pick up in this upcoming week. The money flow index is still above 50, but it is declining. And the ultimate oscillator turned back up in Friday's session. On balance volume, we're still above this advancing moving average. The special K, this is another one that we're watching for. This is a very long-term oscillator. If we can break above this, that could signal a long-term change in trend. The financials had a little bit of weakness in Friday's session, but continue to be weak overall. The regional banking ETF also showed some weakness relative to the financial sector. Looking at our advanced decline line study for the NYSE, we're still above the moving average, also with the S&P and the mid caps, where the small caps continue to decline below the moving average. The Dow still is not able to get above this R1 pivot level. The diamonds remain at neutral. The NASDAQ is just chopping sideways right now. The NASDAQ 100 has also been chopping sideways. The Elder Impulse system for the Qs has changed over to neutral. And we're still above this 38.2% retracement for the NASDAQ 100. We're watching the 12,864 level. We're currently at 13,000. We're still above this anchored moving average for the Qs going back to the all-time high. So far, that support level is holding. The micro caps were up on the day, so they did not set a new 52-week low. The small caps continue to really underperform, and if we keep going down below the 200-day moving average, we might see a death cross very soon. Here's another look at the Russell 2000 small cap index, where we're still above 50 with the RSI. The MACD continues to go up, but we're still well below the 200-day moving average. The small caps have now switched back over to negative for the Elder Impulse system, and the small caps continue to underperform the S&P. The mid caps are still having a hard time breaking above this pivot level, and the mid caps have switched back to neutral. The home builders were up on the day overall with the ETF, so our ratio is starting to show some improvement. Down on the bottom, the S&P and the home builders are having a strong tendency to go in the same direction at the same time. Bond yields were up slightly in Friday's session, which means that bond prices were down. The MOVE index not really telling us too much either on the top or compared to the VIX, but they're still having a real strong correlation between the two indexes. Then comparing the S&P 500 to the longer-term bond ETF, we're still seeing quite a wide spread between the two. Long-term, they have a tendency to go in the same direction. Shorter-term, they're going in opposite directions. Our long-term trend remains intact. We're still above zero with the MACD and advancing. That's suggesting that this breakout above the trend line is still legitimate. An update of our possible positive scenarios. We're still extreme positive with the 10-day average of the S&P 500 highs minus the lows. That could show good momentum. Sometimes when we're really moving up, we get up to this area and just camp there for a long time. The Zweig NYSE breadth thrust did generate a signal that is currently on the books going forward from here. And here are the returns if you look at this on a longer-term time frame. The 5-period moving average of the highs minus the lows continues to be negative, so that's a warning sign. Looking at our ratios, we're still showing some weakness with the Qs compared to the S&P. A little bit of strength coming back into discretionary and not much change with the large cap growth versus large cap value. Our growth value ratios right on top for the large caps, showing a little improvement with the mid caps as well as the small caps. The 50-period exponential moving average of the new highs minus the new lows, we're still above zero and advancing. The indicator continues to be above zero, so that is positive. The 2-year Treasury yield, wondering if this spike and then this drop will give some support to stocks, but it just hasn't happened yet. In our staples to S&P 500 ratio, we're starting to come back up. We could be getting ready to generate a new spike. So what's our outlook for Monday? Earnings is still here and happening each and every day. The technicals are positive, but we may be showing some signs of weakness. We don't have any economic reports coming out on Monday. The whole list of geopolitical events with inflation and interest rates being the real focus of the market, and then earnings on a company-by-company basis. So going over the Stock Traders Almanac statistics, where April tends to be positive overall, what we're focusing on right now is the week after options expiration. It's up 63% of the time and down 37% of the time. And then for Monday's session, we're pretty much neutral to negative with the Dow and the S&P. The NASDAQ slightly a little more positive, being up 52.4% of the time. Then April tends to be a good month. Here is the screen of all of the yearly backdrop things that we're watching to give us this positive seasonality for the whole year. We're on the 15th trading day of the month, where it tends to be slightly up overall with the green dashed line during a pre-election year. Our scenarios can't really go with the down one because we are positive, but there are signs that the market may be starting to weaken. However, we did work off that overbought condition. Can't really go with the up one yet because we're just not breaking out above any of this upper resistance. So we're favoring the sideways trend because the ADX is still above its moving average. So it's a strengthening trend, but we're still below 20 overall. The green line is on top, but it is declining. So then looking at some of our warning signs, volume remains below average. The S&P may be starting to weaken, and maybe. Doesn't mean it is, but there are some signs to be aware of. The VIX is still showing a lot of complacency. The S&P continues to underperform utilities. The summation index based on volume has now turned down. That's a negative divergence with that indicator. The S&P new highs, new lows, they are lagging, but showing some improvement. We're still in a risk-off posturing environment, which is generally more negative for stocks. Small caps continue to underperform. The NASDAQ may be declining from that double top, but we're just chopping sideways right now. And then we are in the middle of earnings season. For conclusion, the S&P is positive, but it may be showing signs of weakness. Same thing with the short term. Intermediate term, it could be showing some more weakness, and in the long term, we're still positive overall as long as we stay above the 200-day simple moving average. Thank you. I hope you found this helpful. I hope that any of the background noise or the difference in sound wasn't all that distracting. Please feel free to send me any feedback that you may have. I hope you're having a really nice weekend, and I will talk to you in the next video.